It's wonderful to see you all here tonight, which is our Finance in Action series, which has been a great success, and we had the opportunity to listen to some really interesting speakers through this event. For those of you that don't know me, my name's James Skinner. I'm Dean of the Business School, and I've been given the privilege and opportunity to introduce you to Michael tonight. So tonight's topic is going to be very broad, and it's going to cover, in some way, current trends in financial markets, potential risks for borrowers and ways that we can actually mitigate these risks. Michael's presentation is going to seek to address interest rates and the lending landscape, along with helpful things to be aware of. So before Michael begins, let me give you a little bit of insight to his background, because I think that gives him, you'll understand when you're listening to him, the credibility he has when he's talking to these issues. So Michael Sutherland, for those of you that don't know him, is here on my right, has 20 years experience in the provision of financial markets advice concerning interest rates, foreign exchange and commodity price risk management for medium to large enterprises. Michael is an authorised representative under NAB's Australian Financial Services Licence, and is as a registered advisor listed on ACSIC's Financial Advisor Register. He's very well qualified too. He has a master's degree in financial planning. I'm hoping that's from the University of Newcastle, Mr. Michael. He's extremely well qualified if he's from the University of Newcastle. If not, he's very well qualified. He has a diploma in financial markets with a Treasury stream from the Securities Institute of Australia, and he's the AFMA accredited across financial markets, debt markets, derivatives, and foreign exchange. Michael has a client-focused philosophy, which I think is really important. Sometimes, the client needs to be at the centre of all these discussions. He prides himself on assisting his clients with innovative strategies to prioritise the client's best interests that ultimately seek to leave them in a better financial position, something that we all want. We're fortunate to have him presenting tonight, and we look forward to listening to his presentation. Please join me in welcoming Michael.
Thank you very much, James. And of course, this wouldn't be possible to have this great opportunity to speak without all of you coming this evening. I know it's been very cold out there in Newcastle, but there's a lot of support here tonight. Obviously, we've got Rebecca Gray, who heads up our lending division here in the Newcastle and Lake Macquarie area. Alex Rogers as well. He's a key representative around here. And of course, if you need any lending or business banking, please reach out to NAB. We are the premier bank for that. And I hope that we can demonstrate some of the ways we can assist your business. And of course, some of the up and coming CFOs in this room. I hope you pick up some tips here. We're here to help, and we're also here to work with you throughout your career journey. So thank you very much. As mentioned earlier, we're highly governed in this field, but anything we speak about today as an AFSL registered advisor is general in nature. We haven't taken into account anybody's personal circumstances or objectives. And of course, any of the views expressed today may not necessarily align to that of National Australia Banks either. So everything's general in nature. Please don't take it as personal advice. But without further ado, we'll launch into the content. Obviously, this year has been a really interesting year for financial markets. It's not too long ago we weren't allowed out past our letterbox to go out and venture into the wider communities. But it's caused a lot of change in the markets, which some items we've taken for granted. We've seen high levels of inflation, asset price growth. It's proving to be a very different cycle to what we saw during 2008. But some of the key points that central bankers have been talking about is obviously long-term interest rates, the level of growth globally, and in particular our main G7 countries, has had a huge influence on the shape of our yield curve and where borrowers can access funding. So there's been a lot of debate about the Reserve Bank and the timing of lifting interest rates when they said they were going to leave it a little bit longer, but they did a pretty good job. I mean, if you look back at 2008, and I'll talk about that later, it was a very different shaped cycle. You know, they're trying to provide a lot of liquidity to business borrowers, and basically give them access to funding when things were looking a little bit rocky. And of course, keeping an eye on long-term interest rates, and of course the financial system still very healthy relative to some of the events we saw during 2008. This is the shape of the yield curve early in January for the US. That's represented by the purple line, and of course where the yield curve is today. So as you would know, following markets closely, studying in the business faculty, you'll know that the Federal Reserve kept interest rates on hold last night. There was some expectations they may cut rates, but we're at a very interesting point in time. So a central bank's first and foremost priorities are to provide market stability, and that ranks ahead of actually controlling inflation. So they're trying to provide market stability. They're also trying to fight inflation. And you might recall only a couple of years ago, they introduced the concept of average inflation targeting. They felt it would be easier to fight inflation rather than deflation. So I've worked at a couple of banks, and the bank I'm at now, we were readying our systems for negative interest rates. So we only had a short space of time, and then obviously lifting that yield curve control was a great thing because everything turned positive again and you started to see interest rates lift. But I don't think there were many people in the business community that expected the rapid increase that we saw, moving the cash rate from just 0.1% to 4.35% where we're at now. But as you can see, we've been through a bit of a cycle this year, but earlier this year, around the Christmas time, we were going into the Christmas break expecting multiple rate cuts throughout this year. Here we are, 1st of August, and they've failed to materialise. There was another opportunity last night to cut rates. Inflation came back just a tick last read in the States. That was interesting, largely reflecting a little bit of a reversal in energy prices. I'll talk about energy in a couple of slides, but housing remains elevated. Insurances, motor vehicle insurance up 19%. You've seen some really strong jumps there, and 5.2% for shelter as one of the key components into the US inflation. And of course, this is the Australian yield curve, a little bit shorter in tenor, but as you can see, what I'm trying to demonstrate through these charts is the minimal movement. But we haven't seen rate cuts. In fact, the fixed rates have moved slightly higher on some of those middle dated tenors that you can see there. So it is an opportunity for borrowers. Certainly if you're thinking outside of the square, you're not paying a premium to protect yourself against some of the unforeseen risks in the broader economies. So looking at growth, so that's one of the key things that central banks were really concerned about. We put the global economy into a deep freeze, we turned it off, we turned it back on, and we waited to see what would happen. Nobody knew what would happen. It was an amazing time in history. But as demonstrated here, growth has been low, but in the central bank's own words out of the US, it's been better than expected. Some of that's attributed to some of the policies that Trump introduced when he was back in power in 17, and that reshoring, so winning back some of that manufacturing. One of the observations that we have the privilege of seeing with Rebecca and Alex in the room is that we've moved from a just-in-time freight management way of running our balance sheet. So if you need widgets from the warehouse, you just ring up the freight company, you get it delivered the next day. You don't need to have that capital tied up in all that inventory. To understanding during COVID, if you don't have the widgets in the warehouse, you don't have a business. So that caused a surge in freight rates globally. You've probably all seen those charts where freight rates have gone up considerably. And of course, the supply chain has all had a knock-on effect, leading to the inflationary aspects that we've seen. But one of the key things I want to demonstrate here, as you can see in this green band, is just how important the US economy is globally. So a rough observation there, it's about 25% of global GDP, so a significant economy. The other thing I want to point out is emerging markets. So looking at growth, have a look at China. So obviously China's going through some problems at the moment, but that could change in a heartbeat with a change of policy, obviously to stimulate the economy. And that has a positive flow-on effect for us because they are our major trading partner. But have a look at India. So GDP has been going really strong, but as wealth increases in those countries, so does the consumption of fossil fuel. So that's another demand factor for fossil fuel, which is also inflationary. So remember when OPEC, they filled all the crushing terminals in the States with oil supplies and drove oil prices negative during the start of COVID. The impact that had on the shale oil industry is that it put a lot of them out of business. And if you look at the Baker Hughes rig count chart, which I don't have in this, but take my word on it, it's been slower to respond to higher prices in the oil complex. The chart on the right is Australian GDP. Obviously, that opens up the debate for cutting interest rates. It is very low at 1.1%, but you'll see later on that there's other reasons why we should be looking beyond that. So we've got very high levels of immigration, we've got a shortage of housing. The three major concerns from our central bank is obviously shelter, the shortage of skilled labour, obviously through the housing sector, and obviously fuel prices as well. Just going to oil here. So you can see that leading into the start of this year, there's a bit of a lag effect in some of the economic data that took a while to come out. So by the time we got to the April release of the March quarter inflation numbers out of the States, we had 3 months of the oil price moving from $70 odd up to that $85 region. And of course that had a very strong uptick in the inflation numbers, and it's been very difficult for central banks to cut interest rates in the face of that. We've seen some volatility here later on. Geopolitical tensions overnight saw a 4 and 5% increase in the various oil. So WTI and Brent were up considerably. And of course, that remains a risk to the upside going forward in some of the future inflation releases. The other thing I wanted to point out, in an election year and with geopolitical tensions globally, we've also got a problem with our crude oil in inventory. So the Strategic Petroleum Reserve, which you'd all be aware about in the US, was depleted to the tune of 1 million barrels a day in the later half of 2022 by the Biden administration in an attempt to free up some of the supply to alleviate some of the upward inflationary pressures being derived from energy. The expectation was that oil would come down again and they'd be able to replenish those reserves, but that hasn't eventuated. So we're at an elevated level now and we're trying to rebuild this. But from a geopolitical standpoint, you think that a new president would want to rebuild this because we're back near early 80s levels in terms of inventory. And it is a strategic thing that countries will need to replenish. Obviously, just a little bit more on oil here. Decarbonisation is something that keeps oil very tight. It keeps it very valuable. If you listen to the head of Chevron in his announcements on profit results, you'll hear him say that nobody globally has in their pipeline of projects additional refining capacity projects. So the refining capacity that we have globally is what we're stuck with as the population continues to increase. As I mentioned earlier, you're seeing wealth start to lift in countries like India, and that's just placing further upside demand on our very limited fossil fuel. The other thing as well, I just wanted to point out that oil demand is obviously well supported. You've got major oil consumers, US, China, India, up in the top right-hand chart. And of course, major oil producers largely resides with countries that are outside of the very stable G7 countries. So again, very susceptible to geopolitical risks going forward. And I'll make that point there as well. So you've got Venezuela, Saudi Arabia, remembering that they took oil prices negative to squeeze out some of the shale oil producers in the market. That's interesting dynamic, and at the most inconvenient times, you see those production cuts to try and lift the oil price. So it is rumoured in the industry that the shale oil production cost of production in the States is around $50 a barrel. So keeping it above that keeps that strategic industry viable. Obviously, some key statistics there. Unemployment continues to be very low. That's a tick from a central bank's perspective to keep interest rates elevated. Obviously, growth, I mentioned earlier, is a little bit of a bone of contention. Growth in China has been coming off a little bit. And of course, wages growth at 4.1%, always heavily watched by central banks because obviously we want to keep inflation under control from that aspect. Obviously inflation, that number changed yesterday at 3.8%, and we saw price increase across the board on those major concerns from the central bank. So housing continues to be a key component of that with record immigration, and we simply cannot keep up with the supply in the housing sector. This is probably one of the most important charts, and what it demonstrates, the yellow line, the stepped yellow line, is the cash rate. The other lines represent 90-day BBSY, so that's your base reference borrowing rate as a commercial borrower. And of course the other ones are the 3-year, 5-year, and the highest one is the 10-year rate. All I want to point out here is that it's unfair to compare the two cycles that we've got next to each other in this chart. So from about March 2020, when Jerome Powell came out with virtually unlimited support for markets, we saw interest rates rebound and equity markets take off again. We commenced the start of an inflationary cycle. From 2008 downwards, that's considered a deflationary cycle. So quite often I get asked from advisors saying, what's the average BBSY rate over that term? And I was like, well, look, it's irrelevant. You're comparing two cycles that are out of kilter with each other. The other thing I also want to demonstrate here is that people might be looking for a cut in interest rates, wishful thinking it to this point in time, but a cut doesn't necessarily mean access to the cost of funds when you're borrowing in the commercial business space is necessarily going to get cheaper. As you can see here, we had emergency cuts after the GFC, but the difference between the fixed rates and of course where the variable rates was close to a 3% spread. So right now, while the yield curve is slightly inverse, i.e. some of those longer term fixed rates are slightly less than the variable rates, it can be perceived as an opportunity. And I'm talking to more people that are starting to consider a risk neutral strategy of half fixed, half floating, or some of our other products that we provide to customers. Interestingly enough, our local economics team here at National Australia Bank have indicated they see the risk neutral rate or the terminal rate they refer to at 3.5% early next year, and that's something to consider. So the shallowness of this cycle is being observed by some of our leading economists as well. So it's very different to a boom-bust cycle that we saw in 2008. This cycle continues to prove itself as a cycle of elongation. Like everything seems to go on forever. We're not seeing that boom-bust shape that we saw in 2008. And that's largely been driven by elevated levels of asset prices. So that wealth effect that the Reserve Bank used, so the invisible hand, I'm sure you'd all be familiar with that. So reinflate the household sector, making them feel wealthy after 2008 so that they hire services to help the employment number. That's how we worked our way out of 2008. But obviously that's very different this time with people sitting on high levels of unrealised equity, and that wealth effect is still quite elevated. Just looking at rents, I was talking about that earlier. I've got some customers in Sydney, and the Australian government's been warned about this, but our infrastructure projects are competing with the private sector. So As you can see, rents continue to move higher, above 5% growth there annually in the last 12 months, very strong. Same in the US as well. The problem is you can't get the trades to finish the projects. The other thing too, and I like the example of structural concrete, 32 MPa structural concrete, used to trade for about $160 to $200 a cubic metre. As soon as there's an infrastructure project nearby, and I'm sure we're starting to experience that near Newcastle here with some of the projects, it doubles. So the builder can't access it at that price, and that just gets lumped straight onto the cost of construction. So I've heard prices up as high as $450 and $500 a cubic metre for structural concrete. Obviously that is also been reflected, similar percentage moves in rebar, Rio, that goes into the building as well. And of course, we've got extended delays with new planning and getting stuff approved. It's very slow. So all of this is inflationary. Interestingly enough, in the United States market, you can see that housing supply has come up off the lows. So normal housing supply is measured in months, usually around 7 months supply. Pre-COVID, at its tightest, it was about 2 to 3 months supply. But the problem with higher interest rates in the United States, and this is a secular argument as well, is that if you want to move house, you're giving up a long-term mortgage for 25 or 30 years at 2-point-something% and stepping into a new rate with a 5 or a 6 handle in front of it. So housing supply is still quite limited there. It's creating that housing shortage, which is a key component in their inflation numbers as well. I do like this chart. What it shows here is the path of inflation that we saw in the early 80s and what can happen if we don't address it properly. So we are at a very important decision-making point for central banks, and they are totally aware of it. If we cut interest rates too early, it can fan another bout of inflation. That's what happened when you had the oil shocks towards the late 70s and early 80s. And that was a little bit alarming yesterday with inflation up at 3.8% here in the domestic market. So we really need to keep across that. But also, if you're working in a treasury for a corporate somewhere here in the local area, you need to be watching those energy prices as well as key components into some of these economic releases. This is an interesting one, the Federal Reserve. So we've got a huge spread of opinions here on where we expect interest rates to be. This is the end of 2025 here, but you can see it's spread across 2.5% to 3%. That's the opinions of the Fed Reserve Board. So it's very hard to determine where interest rates are going, particularly the policy makers that set it don't know themselves. So there is a wide spread there. So yeah, that's an interesting one. There's a really good paper by Robert Schiller. You should look him up if you're at the university here on groupthink. And I think that's certainly looking into as well. But it talks about some of the shortcomings of 2008 and some of the theories to how that may have eventuated. Just quickly here, central government bond holdings. Obviously, we're all aware of quantitative easing. They buy bonds to get liquidity out into the system because without liquidity, interest rates rise considerably. But as you can see here, they're paring back some of their bond purchases by letting them mature in the majority of cases. But it's also coinciding with higher interest rates. Even Japan has lifted its interest rates off the zero interest rate policy. You would have seen them lift interest rates to 0.25% this week. So the world is starting to rise in terms of the interest rate space. Non-performing loans always get asked how the business sector is going. Look, this is just one measure. I think it's a great one that summarises a lot of indicators. But non-performing loans, compared to 2008, we haven't seen that. It's very different to 2008, as I said earlier. People are sitting on high levels of equity and they're reluctant to default on their loans when they're sitting on unrealised wealth. Very different to 2008, where you had red circling, areas like Detroit where they handed back the keys to the bank and got out of their commitments to pay debt on a adversely affected or negative equity in a home. This cycle is quite different. in that aspect. Here's another indicator that just shows the level of bad and doubtful debts. They're still very low, so it's not a bad thing. It's shown that the economy is handling the higher interest rates, the higher for longer theory. May be here for some time, but certainly this is evidence that supports that thinking. Funding composition of banks, it's an interesting one. I hear that great number we saw in the newspapers earlier in the year or late last year, that only a third of homes have mortgages on them. So not everybody is impacted by higher interest rates. There is a segment of our economy that do enjoy high interest rates, and it's led to higher levels of disposable income. So that's a great thing. But also domestic deposits, with rising interest rates, we have to pay more for deposits to those deposit holders. And of course, as a commercial borrower, there's a double whammy effect. Not only are you exposed to your base reference rate being BBSY, but also the bank cost of funds goes up as well. So that's something to just be aware of. Again, an opportunity now with a flat to inverse yield curve to look at your loans, particularly if you've got less than 2 years to maturity. Come and see us at National Australia Bank and we can certainly help you out. Like the banks that we saw globally, you saw what happened over in the States April last year. The bank came in with some emergency provisions to support the initial valuations of 10-year holdings in the second-tier banking sector and alleviated an absolute disaster in banking crisis. They threw $4 trillion at that. And I think that's as a result of the learnings from 2008. That rapid response certainly averted a disaster, but some of the other things like the Basel Accords have also assisted the level of Tier 1 equity that banks hold. National Australia Bank, one of the strongest Tier 1 equities holders, just makes it safer to do business banking with us. So if you're with a bank and they haven't got strong Tier 1 equity, during periods of dislocation, particularly during adverse market cycles, you can see your rates start to increase, not because of your risk grade deteriorating, but because of your bank. So you need banks with deep levels of liquidity, as you can see here with this CET1 number, which measures the equity that the banks hold. This is probably one of my favourite charts, and I think it describes this cycle and distinguishes it from what we saw in 2008. So obviously this shows quantitative easing, the level of it as depicted by the yellow line, but it also shows the impact on the 10-year interest rate as well. So last year, remember, between June and October, the US 10-year rate jumped 1%, and what did the Federal Reserve do? They paused interest rate hikes, and it took a lot of the pressure out of the long end of the yield curve. Obviously, a lot of pressure has drained out of that in recent weeks, and we've seen a lot of curve flattening in it, and it's moved significantly inverse, actually. So that's something to look out for, but there are times in the market where confidence is low, and you'll see that when equity markets are selling off, but the Federal Reserve is trying to roll these holdings of these bonds, and there may not be enough demand in the market. And we saw that in December last year. There were some nights where US 10-year rates were jumping 12 to 16 basis points in one night because there wasn't enough demand in the market to roll those bond holdings to keep this quantitative easing program rolling forward. But the key thing I wanted to point out to you here is the level of Fed balance sheet, so quantitative easing. In response to 2008, we're at $2 trillion. Have a look at the response during COVID. So that was March 20th, 2020. Significant jump. Look where we are now. It's taking some time to try and roll that back. If they roll it back too quickly, you get that phenomenon called taper tantrums. The market certainly doesn't like it. You see equity markets come off because the long-dated interest rates, so the long-term rates, start to jump significantly. And that's not seen as good for business. Obviously, lots of reasons and ways we can help customers. It really comes down to the individual circumstances. I won't go into product specific solutions here, but there are other solutions other than fixed and floating. And again, we have access to over-the-counter derivative markets where we can put something together for you. But I just want to say thank you very much for that. It's been fantastic. And I might just hand over to Rebecca. I think it's a great opportunity this evening to maybe just have a brief talk about what we're seeing in the market, our lending appetite, and without further ado, I'll just hand over to Rebecca for some closing words. Thank you very much. Thanks, Rebecca.
Thank you. Thank you for having us here today. I do apologise, I've not actually prepared anything, so thank you for that, Michael. So as Michael suggested earlier, I'm the Business Bank Executive for Newcastle Diversified Business. So I look after a team of 10 bankers, and we look after businesses really with debt limits up to about $50 million. So I'm happy to open the floor and see if anybody has any questions for me, rather than you listening to me talking.
I suppose the first question is, next week, next Tuesday, up or down, or hold?
Oh, look, I think that's a question best for Michael. That's his wheelhouse rather than mine.
Well, actually, the market pricing has come in significantly. There's only like a 3% chance of the RBA lifting rates next week. The next opportunity for the Reserve Bank to meet will be September, because there's only 8 meetings now. But certainly, it was the core inflation that they were looking at that was a little bit less than expected, but they're just taking their time. So probably on hold next week. So it's a little bit of reprieve, but again, it's a little bit of cat and mouse. So what you see with borrowers, they say, oh look, they haven't risen their rates, I don't have to do anything. And where we come in to try and assist clients is to try and beat the rush for the door. So when you do see positive data that's supportive of higher interest rates in the future, we try to protect our clients from that situation where they're coming in and paying more than they should for protection during those times, because the market has changed its stance and now sees a higher probability of a higher interest rate environment. So naturally the cost of protection goes up significantly during those times. So it's about having a risk management conversation now while markets are calm and benign, and not paying exorbitant premiums for that protection. So when something does happen in markets, you've got a plan in place. So we help clients with treasury policies as well. But yeah, really it's quite diverse. But we're a full service bank. We can help pretty much anyone. Any other questions?
So if you have questions, maybe you need to use the mic, because otherwise Zoom people can't hear you.
We're going to see any more building companies go under? Because as you were saying, price of Rio and concrete was going up dramatically. We're going to see more building companies go under.
I certainly hope not.
Well, I think it's a great question, because that feeds into builders' warranty insurance. And I read something that 1st of July, that was going up some exorbitant level, like 50%. So what we're starting to see, and it's having an adverse effect under the insurance component of our inflation numbers, not just in the States with automotive insurance up over 19%, but you'll start to see that here. And if you look at how insurance works, the concept of it, you have a risk pool of people. So all the low risk people are leaving because they don't want to pay the exorbitant premiums. All the high risk insurance is remaining in the pool. So I don't even know if some of these insurances will remain viable products in the future. Look, it's just speculation, but with these rapid price increases, I don't see how people can afford it. People are dumping it.
Sorry. No, Zoom.
Well, thank you very much for the overview presentation. A question which probably you might not be the one responsible to answer, but just to get your views. Do the governments, particularly here in Australia, have another strategy to fight inflation apart from interest rates? Because to me it seems that's not the right way. I mean, you said about more than half of the homeowners they don't have a loan, which means that high interest rates give them more income to spend more, pushing inflation up. And this creates, again, a big split within the society. The ones that they have and they are better off, and the young generation that cannot afford and they are struggling. So, yeah, interest rates, again, in inflation, I don't think with the current context it's the right policy or the only one. And I don't know whether the context this era might be similar to previous years, whereby, you know, interest rates work to fight inflation.
Well,
And the other question, sorry if I monopolize, we heard the Trump calling the Bitcoiners. Now, I don't know whether that was to get votes or whether there is something behind the cryptocurrency economy and how big it is, and whether this kind of other side of the economy is big enough to challenge the normal economy and the banks, and what we are seeing happening nowadays.
So who to take those questions?
Yeah, we'll probably share them. But look, we can't answer everything that you've just raised there, but I can offer some opinion about the topics that you've just introduced. So firstly, financial markets agree with you. You know, there is some dislocation with some of the fiscal policies that are being applied. Certainly we've just had tax cuts in this country. I mean, how does that work in an inflationary environment? So it certainly adds some reprieve. Certainly, you know, the household savings ratio has been depleted to some degree. So, you know, we are in a very different cycle to what we saw after 2008. And certainly, you know, we had this very coordinated global economy pre-COVID, and all of a sudden we've come out the other side of it. There's a lot of geopolitical tensions, a lot of protectionism, a lot of reshoring, onshoring, and that's also creating growth and assisting economies. One of those is to make, you know, America great, as you saw, 25% of global GDP. That has been the policy there. And I remember during 2017, you know, there was some reversal of the Homeland Act, so very attractive taxation policies for large corporates to bring back funds held in offshore accounts back to the American economy. So you'll probably see a continuation of those themes as Trump gets in. You know, we've seen some positive moves in equity markets as well. There's still a lot of liquidity sloshing around the system, and I think, you know, that last slide that we showed about QE certainly demonstrates some of that as well. You know, I remember growing up, you know, you couldn't have all asset classes positive at the same time. Also, the gold was up or shares was up and everything else was down. Now you see everything positively correlated. Like if you were a pension fund manager, it's very hard to introduce inverse correlation to your portfolio as well. You know, we've seen situations where, you know, bonds are rising and equities are rising at the same time, and I put that back to liquidity in the global system. So that's one part of it as well. And of course, my very simple understanding of cryptocurrency, I had to write a report 3 months ago, and I went through all the top performing currencies globally. It was Turkish lira, Thai baht, and there was a couple of others as well, Indonesian rupee. And what you're seeing during some of these, and I'm just speculating here, but you know, with geopolitical tensions, you see people trying to move capital into some of these other lesser regulated markets. So that's something as well. So I think, you know, Trump, in his wisdom, has probably been very clever. You know, if he put some support behind some of these cryptocurrencies, and I only heard about it through a friend of what you're talking about, you know, he'll be able to introduce some regulation to that as well. So one of the things I look at crypto markets for as a proxy for global sentiment is the fact that sometimes they move in terms of sentiment before the regulated markets do. So sometimes you see on a Sunday night cryptocurrency spikes up and you know sentiment's going to be positive for the ensuing week. And I think that's just a little signal I've noticed in recent years, but they're just my observations. I'm not sure if I answered your question accurately, but I agree with you. Fantastic questions, and it seems very dislocated. There's policies that are conflicting with other policies to try and reduce inflation. Very frustrating. Any other questions?
So, and also on Zoom, so for people on Zoom, if you have questions, maybe you can press the raise hand button and I'll come back to you.
Hi, so you just mentioned the tax cuts. What do you think that'll mean for inflation sort of? Because the whole nation has now more disposable income at face value, but do you think it'll put more pressure on inflation?
It's quite possible, and I think there is an expectation of that. Again, we mentioned insurances earlier, the cost of shelter. Just renting a home is very hard. They're looking at new provisions. You saw in recent weeks where you just can't hike the rent if you're a landlord. But certainly tax cuts like that are normally seen as inflationary, which we've seen in other economies as well. We had a similar policy introduced in the UK during COVID. I think it was one of the shortest serving terms of a politician for introducing that at the most inappropriate time. But yeah, it's something to be seen in the next 6 months. I certainly, as a risk manager, I'd be talking to clients about that and saying, well, we need to be prepared for the potential for an upward surprise when that starts to translate through. The other thing I would add to that is the amount of small businesses that are completing their tax returns right now. So, they've had 2 years of really strong years of profit where they'll be able to access greater levels of borrowing capacity because, as you know, the thresholds, and I'm stepping into Rebecca's territory here, have been lifted, and it's very, very hard to access credit now. It's tough. The assessment rates that loans are assessed on are assessed at much higher levels of interest rates because there is that risk that interest rates could move higher.
Except we don't say it's hard to borrow money at NAB.
No, we don't. We
choose our words carefully.
Yes, we do.
Thank you. Any other questions from the room? Okay, so there are two questions from Zoom. So by Christoph. So first, when can we expect more substantial investment in research, development, and entrepreneurial ventures in Australia?
Look, I must admit, I don't know the answer to that one, but what about yourself, Rebecca?
I'm sorry, I can't answer that either.
I have seen previously, I will just make this comment though, I have seen previously favourably treated taxation programs to facilitate and introduce more industry to Australia. Certainly there are always programs that the Australian government's looking at. I know the CSIRO does a fantastic job of that. I work in agriculture as well. I've been down to southern regions where they're experimenting with cherry trees, 300 kilometres from where they traditionally grow to try and access different periods in the market where the carton price is triple what it normally is during the period. So if it's a question of innovation and introducing more innovation to Australia, we're at the forefront of that globally, and we're always looking for new ways to improve things. But yeah, tough question. Thank you.
Second question by Christo is also related. So how can we move away from monopolized market structures and encourage a vibrant ecosystem of startups and innovative businesses?
Well, I think in part, the government's achieving that through accelerated depreciation programs in small business. Certainly small business in this country, and I think there's like 2.4 million of them, Rebecca, roughly around that level. Without those small businesses, I'm sure our unemployment rate would be adversely affected and very different to that 4% that we're seeing in the economy right now. And I think that's the modern interpretation of the invisible hand of reinflating the household sector by dropping interest rates after the GFC, increase the wealth effect so people employ more people to work on their house and renovations and all that type of thing. And I think that's been adapted through a lot of innovation and encouragement to open up small businesses in this country. And when I travel around the countryside, I've coined my own index, the Dodge Ram Index, and I think that's been very successful with small business owners because of that accelerated depreciation program that we're seeing. And I know the government's introduced some very attractive programs for this tax year as well, but there's a lot of encouragement for people to grow their businesses and buy owner-occupied property through super funds and all that type of thing as well. But no advice, talk to your financial planner or accountant. But I think the government does a lot of great work in that space already.
Thank you. So, how about any questions from anyone in the room? For Michael and Rebecca?
I just said one.
So for the Zoom, yeah.
I've got a big voice.
No, it's for the Zoom, sorry.
Oh, it's for the Zoom, sorry. Just what you said, only about a third of properties are mortgaged in Australia. Does that apply to commercial and residential, or on average?
Residential. Yeah.
Residential and commercial, do you know what rate?
That's a great question. I
Yeah.
don't know the answer to that.
Look, I'm sorry, we don't have the information for that, but some trends we have observed in the bank. So segments of commercial property that have been a standout to us. So warehousing has been ultra strong. Certainly offices, they're obviously, a little bit challenging, work from home and that type of thing. But there has been a transition in the type of commercial property. Obviously, we've had to deal with, the transition from bricks and mortar to online in the retail space, but commercial property has been really strong, and it's one of our very strong lending categories, in particular warehousing, but we've been really strong in agriculture as well. I mean, there's a global drive for protein and feeding populations. I mean, we saw with the Ukrainian war, there was a large percentage of global wheat supply taken out of the system, and one of the early things we saw was some countries cut off the exports of their grain, and we've seen this restriction of food supply. So agricultural properties is something that NAB is very good at also. So anything else you would add, Rebecca? That's about all. Thank you very much.
Okay, so I guess since I'm holding the mic, so I could be selfish and ask one question myself. So I can see that we are well attended by our undergrad, postgrad students, and also by industry leaders in this region. So for our students, right, so we know that the big things, not really related to Outlook. So the current big thing is about generative AI. So how do you see generative AI affect the sort of work that you are doing right now?
That's a really great question. So we're seeing AI particularly coming in and looking at the way we work, the way we build our credit, the way we streamline all of our processes. So it's all about simplifying the way we do things, making it easier, being able to get to decisions a lot quicker. So in our particular space, it can take weeks of an approval process or decision outcome. I'm not sure about you in your market space, but...
Yeah, we haven't seen too much change. Obviously, you saw Nvidia up 12% overnight, but besides that, there's still a huge requirement for people to have personalised advice, tailored advice. I'm sure if everything moved to the AI side of things, we'd all be out of a job. But as we know, financial markets can be very complex, and you need someone involved to provide advice on volatile markets.
Thank you, Michael. Thank you, Rebecca. So, last call for questions. No? Okay, so thank you again. All right, so let's give a round of applause.
CPA Australia, we're a local branch, Newcastle and Hunter. We run these events, and we're looking forward to collaborating more and more with the university. There's a tax discussion group that runs once a month. There's a commerce and industry group that runs once a month. Come talk to me. We'd love to have more students in our groups. We'd love to have the profession engage with us. You can ask Marco about the tax group. He's been a lifelong member, I believe. So there's a few of us around. Ask us any questions. A lot of people from lots of different industries, energy, accounting, restructuring, you name it. We've got them here in the room. So make sure to speak up, and we look forward to you attending our events in the future. So thanks, John Long, as well, for this partnership that we're building here at the university, and we're looking forward to probably another event in about 2 months' time, which I'll provide further details of. But thanks very much, everyone, for turning up. Thank you.